Well, the auto parts giant Linamar managed to grow its sales 10% in the last quarter. And while that was below consensus and what they were looking for, it was against a backdrop of extreme volatility as auto sales have been slowing, and there is still the tariffs that are in place. Nevertheless, Linamar is signaling that perhaps 2019 won't be as robust as 2018. Joining us for the full story, we've got Linda Hasenfratz, CEO of Linamar. Linda, thanks so much for being with us. I just want to talk about the most recent quarter, being able to post 10% top line growth in what we signaled as, a very volatile year. Linamar has been diversifying and getting into different markets. Just talk to us about the different levers you were able to pull against that backdrop.
Yeah, absolutely. So first of all, we were thrilled with both the quarter and the year. I think that we had a fantastic year in 2018, growing top line and bottom line in double digits. In fact, it was our 9th consecutive year of double-digit earnings growth, which I'm really proud of, and I think not a lot of companies can boast of. So how do we do it? Diversification for sure has been a key element. We've been building our industrial business. Of course, we've had Skyjack for a long time. We bought MacDon almost a year ago. In the harvesting equipment area, I think that's gone really well. And at the same time, we've been building our transportation business. So we have a huge amount of new work that is launching, and that's been a big part of the revenue growth. I mean, we've got a backlog of about $4.5 billion of work at full volume that is under launch right now. So that's making a big difference also in terms of helping to drive our growth.
Now, notwithstanding that growth, for 2019, you do say that overall sales growth will be in the mid-single digits. So that does signal a bit of a slowdown from what we saw last year. And analysts point out that it is a change from your forecast even just 2 months ago. So what has happened recently to cause you to kind of temper your enthusiasm for what 2019 could shape out like?
Yeah, so markets on the automotive side are a little softer in both Europe and in China than were forecast back when we announced our third quarter at the beginning of November, which was the last time that we would have come out with an outlook. So things have softened up a little in those markets, and although we were expecting sort of high single-digit growth back 4 or 5 months ago, our expectation is now sort of mid-single digit. By the same token, we do expect to see some margin expansion this year, which means that earnings should grow in the high single digits, which personally I think in soft markets is pretty fantastic. So we have quite an optimistic outlook for the year.
Can you tease out for us what you think was kind of driving that slowdown as you call out the weakness in China and Europe? Are the trade tensions a big part of that? And then does that mean on the flip side, if we get a deal, that forecast could change quite dramatically?
I think in Europe, really the issue was more around new emissions regulations. So the WLTP emissions regulations that came into play late last year created a lot of havoc in the European production environment because there was a lot of testing that had to be done. Cars couldn't be sold unless they had passed this test. So there was a bunch of inventory building up and production cut off. So it was less about tariffs and really consumer demand and more about these emissions and the disruption that it was. Emissions regulations rather, and the disruption that was causing the market. So we do expect to see that carry on into the first quarter. And in fact, the whole first half of the year is forecast from a production perspective to be down a little bit. In China, it's hard to pinpoint what the cause is. Could tariffs be a cause? Potentially, right? I mean, that's, slowing things up and creating issues between China and the U.S. So for sure, seeing a resolution to that, which I'm hopeful is going to come pretty soon, could relieve some of that pressure. And hopefully we see a little bit more growth in China, which is also looking a little softer in the first half of the year, but then growing in the back half, which is what Europe is forecasting as well.
As you talk so much about a diversification and, obviously your big exposure to the auto sector, but you now have exposure to the ag sector as well as non-residential construction through, as you mentioned, the Skyjack business. How do you see that evolving over the next 5 to 10 years? Do you expect that it will be equal exposure between all three and you'll become less and less reliant on autos? Do you have a plan for what that diversification looks like over the next 5 to 10 years?
Well, certainly we want to continue to grow all the businesses. So our overall goal is to grow in double digits. So that's what we ask each of our businesses to do. So from that perspective, they would remain reasonably in the same proportion that they would today. But of course, we're always looking for new opportunities and new markets that we can play a role in. So, what we've tried to do is take what our core is, which is manufacturing, metallic-based manufacturing, supply-based management, purchasing, lean manufacturing, and bring those talents into a bunch of different markets, link and lever between the businesses, and really get the best potential out of each of them. So we're going to keep doing that. There's potentially other markets that we can expand into, but we also see a huge amount of opportunity in these three markets. Lots of opportunity on the transportation side as we evolve into new types of vehicles. We've got huge content potential in electric vehicles, whether they be battery electric or fuel cell electric or hybrid vehicles. So we're pretty excited about the opportunities on the transportation side, and also lots of opportunity both in the harvesting equipment and agricultural market where MacDon lives, and in aerial work platforms for Skyjack in terms of both global growth and expanding the product lineup.
You did mention part of your outlook was affected by MacDon because of those agriculture tariffs. Tariffs is something that you have talked a lot about on this station, specifically the tariffs between Canada and the United States, and you have rallied against them. I wonder if you could update us and whether you see in your conversations with governments or officials that we're making progress on those going away.
Yeah, absolutely. I think the tariffs are a huge issue. I mean, they're not affecting us personally very much, only because a lot of the costs end up falling on the shoulders of the OEM, of the automaker themselves. The end, who's selling it to the consumer. So we're not seeing much impact on our bottom line, but our customers are seeing a lot of impact, and that's a big problem. I mean, right now, half of their profits are going towards funding tariffs, and that just means they have less money to invest in all this change that's going on in the industry, and I think that's a big problem. And ultimately, they're not going to be able to continue to shoulder that cost themselves, and we'll start to see price increases and further pressure on demand. So the sooner we can see the tariffs get eliminated, the better. On the positive side, I think there is good motivation on the part of all of the governments to see a resolution to the issue. I mean, I've been spending a bit of time talking to officials on both sides of the border, and I think people understand that there's an economic toll that is being taken, and that it makes sense, certainly within North America, given that we've just signed a new free trade agreement, to eliminate those tariffs and try and improve North American competitiveness or restore it.
I'm curious, as we're about exactly a week away from the next federal budget, what are you looking for?
Well, I think the number one thing I'd be looking for is tax cuts, corporate tax cuts. I mean, when we saw the U.S. reduce their taxes, it eliminated the advantage that Canada had in terms of a lower corporate tax rate. I think it's critical to restore that. It's very important to maintain that competitiveness. I think there's other areas where things are a little tougher here in Canada, so the tax rate helped to offset that. So I think it's critical that we look to restore that competitiveness in the North American and global marketplace.
Do you think we will actually get that?
I don't know. It remains to be seen. I mean, we saw a little bit of movement on that in the fall with the accelerated depreciation, which is great and good to see. I think it's certainly looking at Canadian competitiveness and what we can do, whether it's tax rates or looking at regulatory issues, are really important. And I do think it's something that our government should be taking very seriously.
Linda, thank you so much for joining us with all your insights.
It's a pleasure to be here.
That's Linda Hasenfratz, CEO of Linamar.